accepting a credit card for coaches and consultants didn't always have such a stigma around it where things were so difficult. Many of the aggregators and big names like, how do we say this? Stipe and Ware, not to say their names, have been causing problems with a lot of coaches and consultants because they've changed some of their policies to where you can no longer accept credit cards from your customers if you're in the coaching, consulting, course creating business. And so what does that do for you guys? Well, it puts you in a real bind because a lot of times you can run for a little while on these platforms. And I'm going to explain that to you in just a minute, why you're able to do that and why that's actually part of the problem. But what you're going to have to do is listen, because this is going to be a little bit detailed, and it's by the end of this, you're going to understand why things are happening the way that they are and what you need to do in order to mitigate your risk and your problems when it comes to credit card processing. So, coaches and consultants are in a business where you're dealing with people remotely in most cases. Today in 2025 and beyond, we're dealing with people on the internet all over the world that can pay us with a credit card and we can take their money. The problem with that is that because of the Consumer Protection Act, they can dispute the charges up to 6 months after the transaction. This causes you a problem because if you are in the success coaching or course creating business, somebody can take your product and your service and your coaching and they can flake on you and decide they don't want to be part of your program anymore. And then they can go back to their credit card company and they can dispute the charges. Now, of course, you can submit documentation, and many times if you have your ducks in a row, you can win the chargeback. But it doesn't mean that you're going to have any less of a problem with the paperwork and the time it takes to submit things and go back and forth with the chargeback department and all that. And so what I want to coach you through right now is what you can do to prevent problems and why the problem exists in the first place. So let's first start with this. We're going to look at the process for getting a credit card processing account. When you go somewhere like Stripe, Square, or some other place that we don't mention their names, you are applying for a merchant account under the basis of your business, right? So let's just say you come in and you fill out a form, right? So there's a form that you fill out, and the process under what we call the aggregators, right? This is the aggregators, or also what they call PayFacs, which stands for payment facilitators. These are not that they don't actually process payments for merchants, but they're not technically merchant service providers. They fall under a different category where you're actually borrowing their merchant account instead of using your own. Hence the name aggregator. They're just taking a bunch of different merchant accounts and funneling it into one merchant account, and then they're using their software, right, to do the funding and things like that. That's part of the reason that, like, when you use an aggregator, you'll notice that the funds go into an account and then they go to your bank rather than going straight to your bank like a normal merchant account. And same thing with payment facilitation, right? It's not payment processing, they're facilitating you using their merchant processing account. I know that sounds, for all of us in the real world, right, that sounds dumb. It sounds like, silly nuance, but it's the way that they got around the fact that they don't have to do certain things on the front end to provide you with the service. They can wait until doing it on the back end. So you come in, you fill out a form, and there's some auto checks, right? The auto checks that happen are also known as what we call KYC. KYC stands for Know Your Customer. There's also this thing called AML, which just stands for Anti-Money Laundering, right? So you have some auto checks in place that are just there to make sure that, like, you're not on Visa, MasterCard's blacklist. You don't have, felony criminal record for stealing, credit card numbers or anything like that, right? You don't have, you're not flagged as a fraudster or anything like that. And then on the money laundering side, there's to do some business checks and things like that. Bottom line is these checks are automated, and so if you don't have any issues on your record, or your business doesn't have any issues on your record, then you're going to get what's called an auto approval, okay? Now this auto approval is not based on a bunch of different factors where a person or an underwriting department looks into your business and said, okay, they're in this industry, they're doing this type of business model, and this is what we can expect from their payment processing. All they're doing is they're just opening up the floodgates, and they're saying, based on these KYC checks and whatever business classification you reported, they're going to then give you a certain amount of leeway within their automated algorithm. So here's what happens, right? Now that you've got your auto approval, you start running some payments through your account. And so you start out with low volume because that's what everybody starts out with. Not for nothing, but everybody that started out in business, they started out with $1, $2, $5, right? They built up to $100,000, $1 million, $10 million, whatever it is that you may at some point either now be processing or hope to be processing someday. So the fact that it's low volume means, right, that it's low risk. Intrinsically, it's low risk. Even if every dollar is at risk of a chargeback, it's still lower risk because of the low volume. But here's what happens in the coaching and consulting business, right? You're working on your marketing, you're working on your hook, your story, your offer, you're working on your funnel, you're working on building out all the processes, and you're tweaking this, you're tweaking that, all to improve the conversion rate all along your process so that eventually you can fill an event, fill a webinar, fill a challenge, whatever process you're using to sell your program. And then eventually, right, you go from low risk to high volume, okay, which is a red flag to a payment aggregator. And the reason it's a red flag is because now low volume equals low risk, right? High volume equals high risk, okay? Now, it doesn't actually mean that it's high risk. If you were a restaurant and you're doing high volume, every transaction, right, is relatively small, and every transaction is tied to somebody buying food. Chargeback volume is going to be under 1%. The processors are going to look at that business model and they're going to be fine. However, for you in the coaching and consulting business, you may be great, and I'm sure that you are. I'm sure that you are talented and you have lots of integrity and you do a great job and you care about your clients and you have a good refund policy and your clients are all very successful because of your coaching, right? But there are those out there that have nefarious intentions and aren't necessarily like you. And so here's what happens, right? They come in, they start pumping in that high volume because they're able to swindle people pretty quickly, okay? And then what happens is high volume, okay, pumped into the account, right? The deposits go into accounts, right? So you have high volume deposit into the account, and then what do? They the next step is to take that money, right? And in this case, right, they clear the account, clear account, and this is where they go and they clear this account and they take that money and they buy, a house in LA or in New York, or they buy a Lamborghini or a Ferrari or whatever it is, the next step in the evolution of the coaches and consultants in the online guru space, right? So they clear the account, but now what ends up happening is they bought all that stuff and now the high chargeback volume starts coming in, right? High volume of chargebacks. But what happens? The account has no money in it, right? There's no money over here. The account's cleared. Well, because the account is now cleared, the processor has by law to give that money back to the customer, especially if you don't respond to the dispute and you're not able to resolve it properly. Then now the processor's left holding the bag because they can't collect that money from this coach or consultant that's in the industry. So I've described to you the problem, but now let's look at it from the aggregator's risk standpoint. The minute they see the red flag, right? So remember I said high volume equals a red flag. The minute they see a red flag equals hold money. Why do they do this? Right? They hold the money because now they need to reduce the risk. They need to say, okay, wait, stop. You've been doing, $40,000 a month, but now you just did $400,000 in a day. We need to hang on to that. Or maybe you were doing $4,000 a month and now you did $40,000 in a day. The percentage of spike is one of the issues in the industry. And maybe it's not a percentage of spike in volume. Maybe you've been slowly, progressively increasing. Maybe for you, it's just a spike in your chargeback volume. That now your percentage of chargebacks versus your total number of transactions or your total volume of transactions ends up going above 1%, which is the high, there's the threshold, right, that most processors hold as their, uncomfortable spot when it comes to chargebacks. So the volume starts pumping in, that equals a red flag. So in order to prevent having any issues with them not being able to come back and get the money out of the account, they hold the money. Now, if you're dealing with a big aggregator, a payment facilitator, then what you end up having happen is they send you an email. They send you an email, and I've seen these emails. I've seen an email that said, we're holding this money, right? I think at that time it was $400,000. And we need, they send you an email asking for documentation. Okay? So they ask you for docs. They ask you for the invoices. They ask you for the click to agree. Here's the reason that they're doing this. They auto-checked you in the beginning. It was easy to come in and to get started. But now they need a bunch of documentation in order to get a handle and an understanding from a risk standpoint as to what you're actually doing and if they're comfortable with it or not. Here's the kicker. Because they're payment facilitators and it's not an actual merchant account, many times what ends up happening is if risk doesn't like it, let's put risk and we're going to put a sad face, okay? If risk doesn't like it, they're going to refund your clients. I have heard horror stories, man. I have talked to grown men in tears because they had the best day of their life, right? They were so excited. They're transforming people's lives, right? Through their coaching and their consulting. They are finally being rewarded for all of the effort that they've been putting in and all the seeds they've been sowing all this time. All to have some payment processor take the money from the customers and hold on to it, right? Put them through a whole rigmarole of trying to figure out whether or not they're going to give the money to you as the merchant, right? And they end up saying, nope, we don't like it, and they refund all of your customers. Now you have to go back to all of those customers and find some other way to re-earn all of that money. I mean, think about it. In theory, right, it should be, oh, no big deal. I'll just tell them to provide me another form of payment. It doesn't work that way, right? A lot of these people cooled off. They're not going to, bottom line, you're going to lose a major percentage of those people in those cases. And so, what is the solution? So I think I've described the problem. You understand that because they don't do their due diligence on the front end, anytime there's the algorithm gets flagged for whatever reason, either a chargeback or extra volume or whatever, they hold the funds and then now they want to go through this whole process of checking everything out. Well, here's the deal, right? If you would do it through a traditional payment processor, or better yet, a high-risk payment processor, or at least a processor that has a high-risk bank that they work with, I should say, then they do the underwriting up front, which means they're going to ask you for the docs, right? They're going to get your docs, right? So they're going to get bank statements, okay? They're going to get, if you have merchant statements already, right? They're going to ask for, they want to see your website, right? They may ask for compliance changes to your website because they want to make sure that the business model is set up in a way that if somebody were to dispute charges with you, that you would win those disputes. Because if you have marketing promises or statements that could be viewed as hyperbolic or like guarantees that are unpromisable, right? That you can't guarantee these things to these people, then they're going to ask you to change those things on your website. And you're not going to like it because like who the heck is some banker or some bean counter in some office telling you what types of copy you should have on your site when it comes to conversion? But what they're doing is they're saving you, right? They're doing that CYB, right? Cover your butt on the front end. And they're covering their own butts on the front end. They're preventing the problem from the beginning. So what happens is, if you go through this underwriting process, okay, it equals security, it equals safety. And you know what else it equals? It equals getting your money on time. Let me also explain this to you. When these companies that do this, like ours, Champion Payments, obviously, we have people that will scrub these things ahead of time, make sure they go to a place, a bank, that is going to properly process the funds on this account rather than, giving you an issue. Now, that also may mean, right? Security, safety, they may, based on how risky your business is, or if you're just brand new to the business, they may ask for a reserve, right? Do you guys know what a reserve is? A reserve means that in lieu of chargebacks, right, to make sure that everything is legit, they may hold, and they'll say, hold, in this case, 10% of your processing volume. And they may do that for 6 months or a year to train your account. And then eventually you can request that those funds be released to you because you've trained the account in a way to where you don't have such a high chargeback volume. And it's not an issue where if you run into hard times or whatever, that the processor is going to be left holding the bag. Hopefully that makes sense. Bottom line is, doing the underwriting process up front provides you with a merchant account that already knows what type of business you're in, what your business model is, and how you process payments and what that infrastructure and environment looks like, so that when you start having spikes in volume, they're not surprised, because you're going to tell them, hey, our goal is to do $400,000 in a day once a quarter or twice a month or whatever it is. And so when it comes through, they know to expect that already. It's not a surprise, and it puts the underwriting and risk departments at ease. So you've heard the horror stories if you're in coaching and consulting, or at least if you've been in it for any length of time. And so it's fine to start with an aggregator to kind of get your feet wet, understand the process, but eventually you're going to have to get a real merchant account so that you don't run into these problems. I have guys that are doing $1 million a month on, one of these big aggregators. And because they have an employee that comes in, right? Because by the way, once you get to that level, you're going to have other people that are dealing with customers. And they ended up, because of the actions of the employee in-house, having a spike in chargebacks. Well, obviously that causes a problem with the merchant account. And now imagine having $1 million a month held up with a payment processor that tells you in 45 days we're gonna relook at your situation. And the only communication you can have with them is via email. That's going to be a frustrating prospect for you, I think. So what I would suggest is, from the beginning, get yourself a merchant account with a payment processor that is willing to get to know your business, so that when these things come up, you're not stuck holding the bag. Obviously, we can help you go through that process. I'll put a link in the description or in the first comment or something like that, so that you can get a hold of us and get yourself set up with a merchant account. But just know that this isn't the only problem that happens in payment processing, and what you need is somebody in your corner, right? Somebody that's on your team, that's on your side, fighting for you, not just somebody in some office somewhere that works for some big company that doesn't really care about your business and their interest isn't tied to the success of your business. So hopefully this information helped you. If you want to reach out, go ahead and do that. You can also email us at info@championpayments.com. I love hearing from you guys. Even if you just have any questions, reach out and we'll talk to you soon.